Welcome. Today we're diving into the put ratio backspread, a strategy that helps you prepare for big stock moves while keeping your risk small. It's simpler than it sounds. You sell a put option and use that money to buy more puts at a lower strike price. The ratio means you're buying more puts than you sell, creating a unique risk-reward setup. The beauty? Your maximum loss is limited, but your potential gain is unlimited if the stock drops sharply. We'll break this down step by step using clear language and a real-life example. Let's get started. The put ratio backspread is a strategic approach to options trading, meticulously designed to capitalize on specific market movements. It's a strategy that doesn't just aim for profit. It seeks to engineer a high-probability scenario where gains are maximized under favorable conditions. This strategy truly shines when a stock experiences a significant price shift. We're not talking about minor fluctuations here. We're looking for substantial movement that creates opportunity. The put ratio backspread is particularly effective during a sharp and sudden decline in a stock's price. This is where the strategy's asymmetrical risk-reward profile becomes most apparent, allowing traders to potentially reap substantial rewards. At its core, the strategy involves a specific combination of put options. You buy more put options at a lower strike price than the number of put options you sell at a higher strike price. This creates a ratio, hence the name put ratio backspread. The beauty of this setup lies in its potential for exponential gains. If the stock price plunges dramatically, the value of your long put options will increase significantly. This increase is designed to be substantial, far outweighing any potential losses. The profits from the long puts are strategically positioned to more than compensate for any losses incurred from the short put options. This creates a buffer, ensuring that the overall trade remains profitable even if the short puts move against you to some extent. Now let's consider the scenario where the stock price actually rises instead of falling. In this case, all of the options involved in the put ratio backspread are likely to expire worthless. But here's the silver lining. When you initiate the put ratio backspread, you receive an initial credit. This credit is yours to keep, regardless of whether the stock price rises or the options expire worthless. It acts as a cushion, offsetting potential small losses. To summarize, the put ratio backspread offers a compelling proposition. You stand to gain significantly if the stock price experiences a substantial decline. This is the ideal scenario for maximizing profits with this strategy. And even if the stock price rises moderately, you can still achieve a profitable outcome by retaining the initial credit received when establishing the trade. This provides a degree of flexibility and resilience in different market conditions. So, what's the catch? What are the potential downsides to be aware of? The only real risk associated with the put ratio backspread lies in a very specific scenario. If the stock price remains relatively stagnant, experiencing minimal movement in either direction, you could potentially face a small defined loss. This loss is typically limited to the difference between the strike prices of the options minus the initial credit received. The put ratio backspread is a strategy that thrives on volatility and movement. It's designed to capitalize on significant price swings. It's not a suitable strategy for a market characterized by low volatility and minimal price fluctuations. A sleepy market, as it's often called, can lead to the undesirable outcome of a small loss. For this reason, traders often employ the put ratio backspread when they anticipate a period of heightened volatility or a significant market moving event. They're looking for the potential for fireworks in the stock's price. In essence, the put ratio backspread offers two distinct paths to profitability, while simultaneously presenting limited and well-defined avenues for potential losses, making it a strategy with a carefully calibrated risk profile. The put ratio backspread's biggest advantage? You know your maximum loss before you start. The worst-case scenario is a small, fixed loss if the stock lands at a specific price at expiration. But if the stock drops hard, your profit is unlimited. The further it falls, the more you make. If the stock rises, you keep your initial credit. So you risk a little for the chance to win a lot. This clear risk-reward profile gives traders confidence and peace of mind. It's a smart way to trade big moves without big worries. High volatility is the secret sauce for this strategy. When stocks swing wildly, options premiums rise, so you get paid more for selling puts and can often buy your long puts for less. High volatility lets you set up the trade for a net credit, guaranteeing a profit if the stock rises. Plus, volatile stocks are more likely to make the big moves you need for huge downside gains. In calm markets, this strategy loses its edge. So, always look for stocks with big upcoming events or lots of price action. Volatility fuels both your safety net and your profit engine. That's why traders love it. Let's dive into a practical example using Apple Inc., a company most of us are familiar with. We'll explore how a specific options strategy, the put ratio backspread, can be applied to AAPL stock. This will give you a clearer understanding of how this strategy works in a real-world scenario and how it can potentially generate profits, regardless of market direction. We'll walk through the steps, the potential outcomes, and the risk-reward profile. Suppose AAPL is currently trading at $200 per share. Now, imagine that earnings are just around the corner. Earnings announcements are often catalysts for significant price swings, leading to increased volatility in the stock. This heightened volatility makes it an opportune time to consider implementing a strategy like the put ratio backspread. The market is anticipating a potential move, and we can position ourselves to profit from it, whether the stock goes up or down significantly. To initiate the put ratio backspread, you sell one put option with a strike price of $195. Let's say you receive $600 for selling this put. Selling the put obligates you to buy the shares at $195 if the price falls below that at expiration. This is the short side of our strategy, and it generates initial income. To balance the risk and create the backspread, you then buy two put options with a lower strike price of $185. Each of these puts costs $250, totaling $500 for both. Buying these puts gives you the right, but not the obligation, to sell shares at $185. This is the long side of our strategy, and it provides potential profit if the stock price declines significantly. The difference between the premium received from selling the $195 put, $600, and the premium paid for buying the two $185 puts, $500, results in a net credit of $100. This means you pocket $100 up front just for opening the trade. This credit acts as a buffer and contributes to your overall profit potential. Now, let's consider the scenario where AAPL's price remains above $195 at the expiration date. In this case, all the options expire worthless. The $195 put you sold expires without being exercised, and the two $185 puts you bought also expire worthless. As a result, you get to keep the initial $100 credit you received when you opened the trade. This is a simple, profitable outcome. However, what happens if AAPL's price drops to $185 at expiration? At this price, the $195 short put will cost you $1,000, and each of the long puts will be worth $0. The net loss will be $900 after subtracting the initial $100 credit. But let's consider a more dramatic scenario. Imagine that AAPL experiences a significant downturn and crashes to $160 per share. This is a substantial move, and it's where the put ratio backspread can really shine. With AAPL at $160, your two long puts with a $185 strike price are now in the money. Each put is worth $25, the difference between the strike price of $185 and the stock price of $160. Since you own two puts, their combined value is $5,000. This represents a significant potential profit from the long side of the trade. However, you also have to account for the short put you sold with a $195 strike price. At $160, this put is also in the money and will cost you $3,500. The difference between the strike price of $195 and the stock price of $160. Subtracting this $3,500 from the $5,000 profit on the long puts leaves you with a net gain of $1,500. Adding the initial $100 credit you received brings your total profit to $1,600. This example clearly illustrates how the put ratio backspread allows you to potentially profit from both significant upward movements by keeping the initial credit and dramatic downward movements in the stock price. It's a strategy designed to capitalize on volatility and uncertainty in the market. One of the key advantages of the put ratio backspread is that your potential risk is limited, while your potential reward is theoretically unlimited. The maximum loss is capped at a defined amount, while the profit potential can grow substantially if the stock price falls significantly. That's the power and versatility of the put ratio backspread. It's a strategy that can be tailored to your specific risk tolerance and market outlook, offering a unique way to navigate the complexities of options trading and potentially generate profits in various market conditions. Here's how to set up a put ratio backspread. First, pick a volatile stock with a big event ahead. Choose an expiration date a month or two out. Sell one slightly out of the money put and buy two further out of the money puts. Aim for a net credit if possible. Use your broker's options chain to build the trade as a single spread order. Double-check the details, strikes, dates, and risk before submitting. Once filled, your position is live. Exiting is simple. If the stock rises and all puts expire worthless, you keep your credit, no action needed. If the stock moves big before expiration, you can close early by reversing your original trade. Buy back the short put, sell your long puts. If the stock plunges, set a profit target and close when you're happy. If the stock hovers near your max loss zone, consider closing early to limit losses. Always use combination orders to close all legs at once. Having a clear exit plan is key. Don't leave it to chance. Manage your trade, lock in profits, and control risk. That's how smart traders win. You've just learned the essentials of the put ratio backspread. It's a strategy for bearish traders who want upside, but also crave protection if things go wrong. Remember, find volatile stocks, set up your trade for a credit, and always have an exit plan. Practice with paper trades before risking real money. With knowledge and discipline, you can use this strategy to your advantage. Thanks for watching and happy trading. See you next time.